Let's face it, one of the best parts of a job is getting paid. Some companies will give you a physical check every week or two, while others might offer to deposit your money electronically into your bank account. Either way, seeing your pay for the first time might not be what you expected. Why is the money you received less than the money you earned? Where did the money go? The answer is to examine your pay stub, the document that usually accompanies your paycheck. A pay stub summarizes how your money is allocated over a given pay period. It also proves that your employer is giving you what they promised. It's essential to understand how to read a pay stub. The first item you should note is the pay period. These are the calendar dates you worked that the paycheck covers. This is different from the date when the check was written or when your money was deposited. If you're a part-time or hourly worker, the pay stub will note the hours worked during that pay period and the hourly rate you're making. When those two numbers are multiplied together, you get what's called your gross pay. This is the money you earned during the pay period before any taxes or other deductions are made. The pay stub will also tell you the total amount of money you've earned in the calendar year to date. Next, you have those lovely taxes and deductions, the amount subtracted from your gross pay. Required taxes include federal income tax and, depending on where you live, you may also have to pay state and local income taxes as well. Federal law also requires you to contribute a percentage of your earnings to Social Security and Medicare programs. Other deductions on your pay stub may be contributions towards your company's medical insurance plan, union membership dues, and additional employee benefits you're receiving. Lastly, and the number that probably matters most to you, is your net pay. This is your actual take-home pay after all taxes and deductions have been factored in. It's generally a good idea to keep your pay stubs for at least a year. They can come in handy when preparing your annual tax returns. Keep in mind, paycheck tax withholdings are only estimates of what you'll actually owe. If too little was taken out from your paycheck, then you'll be required to pay the balance each April. On the other hand, if too much money was withheld, then you're entitled to a refund, and that's a good surprise to see.